claimed infinite banking concept was a scam and actually got quite pissed off about it.
All right, if you watch enough of this channel, you know I like infinite banking, and Dave Ramsey typically doesn't. It's interesting to see this video on the Dave Ramsey Show, as he's talking with a guy that's a big client and fan of infinite banking, and what Dave has to say. And although Dave's poo-pooing all over it, he's not wrong in many cases. Let's watch it right now. I'll tell you why.
You claimed infinite banking concept was a scam and actually got quite pissed off about it.
Mm-hmm.
And I have set up a policy for my son when he was 1 year old. He's 5 now.
I'm sorry.
Say that again?
I said I'm sorry.
Yeah, so am I sometimes. No. So I set that policy up for him when he was 1 year old.
Mm-hmm.
It has a $500,000 face value.
Mm-hmm.
We pay $5,373 a year for 13 years,
Mm-hmm.
and it's paid up at that point.
Mm-hmm.
There's a few points that I wanted to discuss that I just didn't agree with.
Okay.
Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you,
Mm-hmm.
and you only get the face value paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value. Dividend reinvestment is because you have a mutual company, and the policyholders are the owners of the company. And so the profits from the company come to the policyholder, and they use that to buy paid-up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
But it still works out to be having a cash value much greater than the $69,849 we put into it.
But the actual cash value, not the paid-up additions, the actual cash value dies with you.
No, because
yes, it does.
Okay, but your death benefit is larger than your cash value. So for me, I looked at it
because you bought more insurance. You know what a paid-up addition is? A paid-up addition is buying additional insurance.
I understand
That's why you're getting more at death. Not because you got your cash value, but because you used your policy dividends to buy additional insurance.
Right, but
that's different than getting your cash value. If you
So I'm going to pause it right here because they kind of go back and forth. But what Dave's saying has truth. What this other guy is saying has truth.
So who is the real?
The thing is that Dave refuses to let him have this one, even though the guy is correct, but he's not letting him get a word in, as you can tell, right? He keeps interrupting him. He's like, no, it's buys death benefit. That's not cash value. The guy's saying, well, no, it is. Well, the guy's right. And Dave Ramsey is telling some truth here, but there's just that slight bit of untruth that makes this not true from Dave Ramsey's part.
Don't lie.
Let me show you what I mean. His claim is, if I pay extra into this, which is more than the minimum premium, you buy what's called paid up additions. That's basically overfunding. It's overpaying for your policy. When you pay extra, that extra goes in your tax-free savings account called cash value. So you're basically paying extra into it. So the guy calling in, he's arguing saying, well, wait, no, I'm getting cash value from it. And he's correct. He is building up that savings account inside that he can access and pull out. Dave Ramsey is also correct that he's buying more death benefit. What Dave Ramsey's not acknowledging here is that you actually buy death benefit and get the cash. You get 2 for the price of 1 is what you're really getting. You get more death benefit. Yes, you're buying more, but you're also getting cash. So for example, in this example, I just did apples to apples. I'll probably, depending on how this guy set his policy up, we probably will end up kicking his butt. So our numbers might be better than his. He didn't disclose or show what that really is. But as we look at it here, he's putting in $53.73 a year is what he said. Now, he said he bought $500,000 of death benefit. I'm showing what we would normally done. It would bought just over $400,000. But that first year, when he pays $53.73, understand that extra paid up additions that we're talking about here, we're paying an extra about $4,200. So of the $5,300, only $1,100 is going to pay the premium, while the other $4,200 is going to buy up extra cash. Now that $4,200, what did it do? It did buy more death benefit. It actually bought about $50,000 more death benefit in that first year. Dave's argument, you're going to hear later in this video, would be, Well, you just buy term insurance with that. You just save the money, buy term insurance, which you could do. Well, by the way, most of the time it's kind of tough to get term insurance on kids. In fact, they're pretty expensive to get term insurance on. Not always the best way to go. But let's just go with it, right? He buys term insurance on the kid, and he'll say, hey, great. Well, now you save that money, you put it away, put it at 12% per year or whatever he's thinking it might be, and you'll have $25 million, right? Just save that money, not buy the dumb thing, just buy term. And then you can just have $25 million. You won't even need the term later on, right? That's what he's saying. But the truth is, he can have that extra cash in there and still also buy $50,000 of death benefit. So you get both. Now, granted, here's the thing. After 13 years, that means you've paid in about almost $70,000. Even after those 13 years, you'd have about $85,000, right? Now, Dave says, well, down the road, you'll have $25 million at age 88. Well, let's look at this. Age 88 on this thing. Now here, he's got about 3.1 million, not 25. Already, from what Dave's saying, this sounds amazing. It sounds miraculous, right? Because I'd rather have 25 million than 3 million. And even then, with the death benefit, it's really only about 3.5 million. So yes, you do get the cash value and you do get the death benefit. The problem is, and many people argue with this, even on our channel online, they'll say, yeah, but the cash value, you don't get it when you die. The guy's argument is you do. There's right and wrong. Most policies, you do not get it back. So Dave Ramsey is right, and so are a lot of the critics about life insurance saying, no, you don't get the cash value back because you're right, that cash value gets rolled in death benefit. But if it's done the right way, and that's like the way we talk about doing, yes, he got 3.1 million. And remember, the initial death benefit was only about 400,000. He still get $3.5 million. So you can still get all the cash value plus the death benefit in the end, at least if you do it our way. But I'm saying this as a disclaimer, most insurance agents do set up policies that don't do this, okay? So again, that's another myth, another thing that everybody keeps poo-pooing all online, saying that, oh, whole life, you don't get any of your cash value back. You do if it's done right. But they're right. In most cases, it's not the case. Now, let's go back to what Dave Ramsey was saying about the 25 million.
Value, and my point is 100% of the time, by definition, you lose the cash value.
Okay, so as I said, tit for tat, if he lives to be 80, I'm looking at the readout here. If say he only lives to be 80, okay? All right. The cash value will be worth about $2 million. Yeah. But
by the way, this video is actually from a few years back. The policy he got was better. Policies were cheaper back then. So lucky. So yeah, this guy is overpaying, basically. He's overpaying because even with more expensive policies, we still beat out 2 million. So we got over 2.1 million in ours right now at age 80.
Yeah. But the payout for the death benefit will be 2.6 million. So okay, technically yes.
So you take the cash you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about because you get a better buy on the insurance than you're getting with this rip-off whole life crap.
Yes, you would get a high, but you wouldn't be able to use it throughout your life as your own bank.
Well,
I think that's
okay. But here's the thing: that's a side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement. Well, let's just do a little present value calculation on what you put in for a baby. $5,000 a year for 13 years. Do you know what that would be in a mutual fund? At age 88? It would be $25 million, dude.
He's going to have that anyway.
No,
Curious, how did he get that number? Well, I ran the math. Guess what? If you did $5,000 a year for 13 years at age 88, it would be like a 7.6% return to get 25 million, which actually is better than Dave usually does. I think he miscalculated on his own numbers because he always loves to say, you make 12% in the market, which you never do. The average of the actual stock market has been 7.75% for the last 30 years. That's the actual return of the S&P 500. And when you put your money in mutual funds like he's talking about, most people never even get close to those kind of returns. So he's being a little bit aggressive here, a little bit overkill, but let's just say it is 25 million.
Well, he's going to have that anyway.
No, instead of putting it into this rip-off thing and making 4% on your money, and when he dies, he loses his cash value, if you had put this in a good mutual fund, you'd have 100x, 10x the amount of money, and that's your infinite freaking bank.
Okay, so now he's just pulling numbers out of his butt. 100x. Okay, maybe it's 10x. But yeah, it is. So let's go with that, right? Because he's not wrong. See, Dave Ramsey, he's doing his own calculations. Now, I think he's overestimating. I would say that you'd be lucky to get 7%. Okay, let's be honest. I ran that same calculation for, trying to do that for those 80 years or whatever. It's not going to be as dramatic, right? Again, like I did 7.6%, you got 25 million. Let's just say we go with that by age 88. What's that really going to be worth? I mean, remember the kid's 1 year old. 88, that's 87 years future, almost a century in the future. You don't think inflation is going to go up like 10 plus fold from that period of time? It's very likely, unless of course we change things. But the rate we're going right now, that's not going to be worth anything anyways. But it doesn't matter. Inflation doesn't matter because the truth is, and you guys already said in the comments for this video too, the $25 million still trumps the $2.1 million that he has in his personal life insurance. And Dave's right. He lets it sit there. Even if you factor in that it's tax-free versus putting in a mutual fund that's taxable along the way, that's one thing that Dave didn't mention. If you actually get taxed along the way in a mutual fund, because you're not likely, you could put in a Roth IRA maybe, but the truth is that we don't know if the Roth IRA is even going to exist down the road. And once the government changes the rules in 87 years, you don't think they're going to change rules? That could go away. All that tax-free ability could go away. So most likely you're buying a plain old mutual fund. If you happen to get that 7.6% like Dave is claiming, you go from 25 million now down to about 4.5 million. Now still double what you get in the life insurance, right? Remember, it was about 2 million in the life insurance, 4.5 million if you're having to pay taxes. But there's more, because this guy was trying to say it, but it's not totally true. I would agree that it's very likely, even possible, that you could have more inside the stock market put in a mutual fund. Nobody's discrediting that. The one thing that Dave isn't really addressing, because he keeps talking about having a term policy. Well, guess what? You're not going to have a term policy at age 88 because companies purposely make it to where you can't do it. I actually ran numbers. I tried to run the same kind of situation he's talking about, a 55-year-old for a 30-year term, because they'll stop letting you do it up to that point. If I try to pay somebody 56 years old, I can't get a term policy on him. But 55, I can. For 30 years. I mean, it only gets to age 85. Well, guess what? That premium for that $500,000 goes up over $100,000 a year. So what happens is really by age, just after age 85, right? When you get to the age 88, you've already paid more than your death benefit. And there's already stats coming out from people alive today. If you're 65 years old, you already have at least a 25% chance of living to 92. What's that going to be like in another century? I'm not saying people are going to be healthier, but if medical advances continue, who's to say that almost all of us could live to be 100? So again, he's trying to tell you, you can buy a term policy. Well, if you try to buy that term policy at 55, what if you're not insurable anymore? What if you get that brain tumor like some of my clients have had? I had 2 clients have brain tumors. One had a policy that he was able to keep still regardless of that. The other couldn't get a policy because he decided not to get the insurance before the brain tumor. Neither of them now, if they try to get a new policy, can get one. The only one that can have one is the one that already had one before. So we don't even know if this kid get a policy. So there is no death benefit. Let's just say that Dave's right. Maybe you are worth 25, maybe $1 million more, right? Well, at what point are you considered rich? Because remember, even in today's dollars, if you have over 12.9 million, you have a 40% estate tax, which means you lose almost half of your money to taxes when you die. With life insurance, you don't lose the death benefit. The death benefit comes to you and your family tax-free. It doesn't come to you because you're dead. It goes to your family tax-free, right? So, like he says, tit for tat going on here. But here, to me, this is the moneymaker. This is why I use infinite banking versus just throwing a mutual fund. This one big reason is what I can do here. I can take that money and not put in mutual funds if I have it in life insurance. And life insurance, not only is it guaranteed and I can make money there, but I can also get a line of credit against it from the insurance company and buy real estate properties. And I'm telling you, if running the numbers is ridiculous. I try to run the same numbers, like talking about what Dave Ramsey's doing, because I can actually just take the money out of the policy. See, Dave's thinking it just sits in the policy and does nothing. Most insurance agents will tell you to do that. Just let it sit there and grow, and it will not win. Most likely, Dave is going to be right that the mutual fund will beat the life insurance cash value. But what if I can take that cash value out and use it to invest wherever I want? I could technically invest it in mutual funds and still do the same thing Dave Ramsey's talking about. Now, I wouldn't do it because I don't trust mutual funds. I would rather put it into real assets like real estate, where I can make easily double-digit returns. Now, I ran the same numbers, and I only ran it at 15% interest rate. Just so you know, I have properties that have paid me 300% over the last 5 years. I have some properties right now paying me like 25+%. I didn't show you those numbers because let's just say you wouldn't believe it, okay? But I ran 15% because it's more believable. There are investments that pay 12 to 15% contractually. in the real estate space. So I did the same thing. What if that kid paid, and I only did $5,000 a year, just like Dave Ramsey was calculating, right? $5,000 a year for 13 years, and then just let it invest. At that 15%, it is compounding. Guess what? At age 88, you have $4,868,974,240. Or in other words, you have almost $4.9 billion. Not 25 million, 4.9 billion. Dave, take that. That's what I can do with my infinite banking policy. Now, this guy never got to do it, and that's what happens. You call into Dave Ramsey Show, don't ever expect that you're going to get a decent thought out, because once you try to make a point, he's going to try to counter. He's going to interrupt you. He's worse than I am when I'm talking to my wife sometimes, right? Like I know what you're going to say. I'm just going to correct you. And then I'm sleeping on the couch. That's what happened. That's what should be happening to Dave Ramsey. He should be sitting on the freaking proverbial couch for interrupting people and not allowing a thought to even continue. And maybe this guy couldn't quite articulate it this way. But the truth is this, is that Dave is right. And this guy is right. Dave is right because you could make $25 million and make more than just letting it sit in the life insurance. This is why I'm not a proponent of just letting it sit in the life insurance, although that's not a bad option. The better option is you can use that money to invest wherever you want to make better returns more safely than what you can do in the stock market like Dave's recommending. That is a real key to freedom. That's a legacy you can leave behind. Imagine what that could do for you and your family. What could that do for your kids and setting them up and setting a legacy for children, grandchildren, and great-grandchildren and generations beyond, especially if they understand these principles. And by the way, Dave Ramsey, I used a present value calculator just for you, just for these numbers. You're welcome.
Thanks, Dave.
If you love Dave Ramsey, you want to see more of his stuff, check out what he actually said about my friend, my real estate investor friend, and how he ripped on him. Check out what he said here. So I just got done filming this video with Dave Ramsey ripping on this guy that's a client of Infinite Banking. And the guy was trying to make the point. He's like, well, Infinite Banking's better than what you say you can do. Dave Ramsey's argument, I can make more money in a mutual fund. And Dave's right. But what Dave didn't let the guy address is that with my Infinite Banking policy, I can invest it in better places than the stock market and still have a death benefit to leave a legacy for my family and make way bigger returns. Dave Ramsey says 25 million. I can say conservatively 4 billion. I know it sounds crazy. You should watch the video to find out more in the description below.